Why are Australians Googling inflation in the masses? Australia's Reserve Bank has raised the cash rate to 0.35%, up from the record low of 0.1%. And this is the second time the cash rate has been increased during an election campaign, and the first time since 2010 since Australia has experienced a rate rise. Although many other countries are experiencing much higher levels of inflation, such as Russia with 16.7%, Poland 11%, Spain 9.8%, Chile 9.4% and USA 8.5%, Australia's inflation rate is at about 5.1%, with expectations for the cash rate to reach 2.5%, possibly sooner than expected. And from what was thought of as transitory inflation, now the banks are forecasting that things could get worse before we see an improvement, and it seems that the average Australian is wanting to know more. In today's video, we'll investigate into the factors and demographics influencing inflation and the importance of CPI and PCE data. Please subscribe to the channel. I'm Sage for kalkinemedia. It may be that the economy is reacting to the expansionary phase we experienced after the pandemic era, which impacted the labour market and supply chains. We may need to ride out this phase with prudence and patience, as inflation could only fall by 2024. Could we be at risk of fiscal drag? Will a recession be looming with the anticipation of the Reserve Bank of Australia to raise rates to neutralise the inflation? Recessions have also historically solved issues with rising inflation. Markets are expecting the cash rate to average 1.1% over time to eventually reach 2.5%, even by as soon as the end of 2022. So what was an economy that was destabilised due to pandemic restrictions and quantitative easing in order to provide stimulus to a gridlocked capital infrastructure? The geopolitical issue of the Russia-Ukraine war has exacerbated those tensions, with the most obvious example of this in Australia being the rise of petrol prices to over $2. And although the temporary reduction in fuel excise is keeping fuel prices under $2 at present, they are still historically high. The calculations of inflation have been altered to meet market pressures in the 1940s and the 1970s in the USA, the reason being high volatility. Cost of living and how it relates to inflation and wage growth is deterministic of the economic health of a nation. The Consumer Price Index, or CPI, came into being in the 1960s in Australia, and like the Purchasing Managers' Index, or PMI, it plays a role in the negotiations relating to industrial activity and manufacturing. Another factor that impacts how well an economy copes with inflationary pressure is the vigour of the labour market. There has been some criticism about the way CPI is calculated, especially for the emerging economies, where food and shelter are difficult to separate from the everyday cost of living. To some, there appears to be an elitist bias. We'll now cover the 4 criteria that technically factors the interpolation of the CPI: core inflation and headline inflation. The US Fed has produced inflation indicators that have excluded the cost of energy and food. This has been since the year 2000 and is also known as the underlying inflation or core inflation. The main issue being volatility. The smoothing out of the data presented is sometimes criticised, as the estimates can't be clearly separated into their varying categories. The CPI data is prepared by the US Department of Labour branch called the Bureau of Labour Statistics. The unadjusted inflation figure is referred to as headline inflation, which does take into account the highly volatile energy prices. Along with the PMI, or Purchasing Managers' Index, there is also another measure of inflation. This is PCE, or Personal Consumption Expenditure Index. Traditionally prepared by the Department of Commerce in the USA, this data is preferred. PCEs incorporates expenditure on not only durable and non-durable goods, but services as well, which hallmarks it as the preferred measure of inflation for the US Federal Reserve. The base effect. Distortion of the headline inflation is unavoidable due to the macroeconomic factors having an impact on the broader economic sectors. In the pandemic era, the stimulus programs and quantitative easing has caused a distortion in the current inflation reading, which has been again exacerbated by the Ukraine-Russia conflict. Economic bubbles like the housing prices increasing significantly, as well as cost of used cars, furniture and services like hairdressing, all add to the impact of the base effect too. Other anomalous increases can also be seen to distort the inflation data. In Australia, the price of imported goods and domestic services were on the rise. How well the wages data can keep up with these increases will be the key factor as to how severe a recession is to be anticipated. A divide is apparent, with some economists seeing inflation to detract inflation, and others say that increased inflation will attract more inflation. Some expect a recession by 2024, and others believe it will only be then that the inflation reading will decrease. In Australia, we have witnessed significant increases in petrol, construction materials, as well as produce like beef and vegetables. It was reported by the Financial Review. An increase month over month in consumer spending is a healthy indicator of expansive economic activity, but whether this was enabled through the lending of capital from banks could then lead to further tensions with a hawkish stance from the Federal Reserve and further interest rate hikes. Thanks for joining us on this report, and if you like the information, let us know by liking, sharing, commenting on the video below, and subscribe to the channel. If you press the bell icon, you'll be notified of the most recent videos by Kalkine. But for more articles, head to the website kalkinemedia.com. My name's Sage for Kalkine Media.